Hi everyone, we are now ready to review problem 3-35A on page 167. In this chapter, you were introduced to many new and different types of ideas in accounting. I guess that's the best way to put it. And what you'll find is when you're working on P3-35A or any of the problems in this chapter, I should say, that the information is presented differently. Now, remember from the lecture, what is happening here is the company is getting ready to do a financial statement in Chapter 3. So we've been working in what's called the accounting cycle. It's a one-year period of time, and all the steps that we're learning from Chapters 2, Chapter 3, and Chapter 4 must be completed in an accounting cycle or an accounting year. So that's why it's imperative that you understand all of Chapter 2 and how to make journal entries, because that's accounting. Okay, so just so you realize that. But what are we really focusing on in Chapter 3? What's this adjusting process all about? Well, we're still in our accounting year that we began in Chapter 2. In Chapter 2, we've been recording all of our normal business transactions that happen every day in our company as a journal entry and posting those journal entries to the effective T account in the general ledger. Now remember, the general ledger is the center of our accounting system. Everything flows through those T accounts. Any kind of financial transaction that must be recorded in our accounting system. And then at some point, at least once a year, sometimes it's once a month, the company will say, let's create financial statements. Let's create an income statement, a statement of owner's equity, a balance sheet, and the final one, which is the statement of cash flow. It's at this point the company creates that first trial balance you saw called the unadjusted trial balance. That was in Chapter 2. And it's where we pick up in Chapter 3. So on page 167, you see their Aniston Air Purification's unadjusted trial balance. So that's where the company stands right now as far as their balances go in their general ledger. So the very first thing you should do is create a T account for each of these items listed in the unadjusted trial balance with their unadjusted balance. That's really the balance you came up with in Chapter 2. Your author here does that for you, so you don't have to repeat all of Chapter 2 stuff in order to even get into Chapter 3's. We're just going to focus on the information in Chapter 3 here. But that's really where you are at in this company's accounting cycle for this year. The company has decided we're going to make financial statements. That's what always creates this next step that you're learned about in Chapter 3. Now, what do we have to do? Very simply put, at this point, we can't prove that we have all of our expenses and all of our revenues recorded. And in Chapter 3, you are introduced to the revenue principle that says revenues are recorded when they are earned. And you are introduced to the expense or matching principle that says expenses are recorded in the accounting year they occur. They happen. We can't prove that as of right now, that everything that has been earned is recorded and everything that has happened as far as expenses has been recorded. So what we do is we collect data, and accountants, we know what to do and where to look for this data. Your author, though, has found the data for you. Now, if you find any missing revenues or expenses from this data, you create a journal entry to get it recorded. And that's what we call adjusting journal entries, where we're seeking out missing revenues and expenses and getting them recorded. Now, your author does that for you. The hard part of this chapter is figuring out how to create the journal entry from the data your author gives you. In chapter 3, your financial transaction was presented as received cash from customer on account. And you could say, oh, okay, the customer paid us cash on what they owe us. It's the information, this data isn't presented that way in chapter 3. So that's part of the hurdle here. You're just told about something and then you got to figure out, do I have to record any missing revenue or expenses? And if the answer is yes, you'll be creating these adjusting journal entries, which are categorized into one of 5 categories. And we're going to see all 5 in this problem: prepaid expenses, unearned revenue, depreciation, accrued expenses, accrued revenues. Okay, so let's get into this data. You already have your T accounts created. We're going to get into the data and see what kind of journal entries come out of this data. And you're going to see them all at once here, but we're going to take them each one at a time. In Part A, the data says, on December 15th of 2018, Aniston contracted to perform services for a client and got $3,100 in advance. Aniston recorded this receipt of cash on December 15th, a debit to cash, and a credit to unearned revenue. If you look at the unadjusted trial balance or at your T accounts you created, in the unearned revenue account, that liability, there's a $3,100 balance. And it's still there as of right now, December 31st, the day we're getting ready to do our financial statements. Oh, but wait, the most current data says as of December 31st, Aniston has completed $2,100 of those services. So as the 15th, when they got the cash, they said, hey, we owe this service, all of it. But the most current data as of the end of the year says you have earned it, part of it anyway. So the part that has been earned has not been recorded as a revenue yet. So what we have to do as an adjusting journal entry is debit unearned revenue, the liability account, for the amount that we have performed. Aniston has performed $2,100 of those services. Debit the liability account to decrease it. You don't owe that anymore. Credit the service revenue account because that part of that prepayment from the customer has been earned as revenue by December 31st. So the assumption is that no one has done these journal entries yet. So that's our step now, is to make these journal entries, get that revenue recorded. So this is the typical journal entry you have for that first type of adjusting journal entry, unearned revenue. When you have an unearned revenue account, you have to see, hey, as of the end of the year or the time I'm going to do this financial statement, have I earned any of that? And if I have, has it been recorded? In this case, it wasn't. Get it recorded. And you can only do that through a journal entry. Let's look at B. Aniston prepaid 2 months of rent on December 1st. And they come right out and say, now assume the prepaid rent balance you see above, or in that T account you created, because it's the same thing, the $2,900 debit balance, that's those 2 months payments. So as of December 1st, they paid for December and January's rent. Well, the question is, it's December 31st. Has any of that rental service been received? And the answer is yes. You've used up a month of that rent. So we debit rent expense for the portion that is now an expense and decrease that asset prepaid rent, $1,450, 1/2 of the $2,900. And that's all the little asterisks are there. In my answer key, it shows the how they came up with the computation, and it's 2,900 divided by 2 times 1 month. So as of December 31st, when the company does receive a month's worth of rent, now it's rent expense. So increase rent expense, decrease the asset prepaid rent. We received that portion at Aniston. in C. So that's a prepaid expense example. And so is C. Aniston used $750 of office supplies. So let's get an understanding of what office supplies, what happens there. You'll see on the unadjusted trial balance, office supplies account balance right now is a debit of $1,800. So if we left that at $1,800, it would look like we have $1,800 of office supplies in our closet. Well, the most current data says, well, no, we used up $750 of those office supplies. As we used up office supplies, they're no longer an asset. You don't have them anymore. They become an expense. So we credit the office supply asset account for the portion that's been used up, decrease that account. We don't got them anymore, right? Debit supplies expense because now they become an expense. Office supplies is another example of a prepaid expense. The day we buy office supplies, they're an asset, we own them, but as we use them up, they become an expense, just like prepaid rent. So there's another example of a prepaid expense adjusting journal entry. Now, in Part D, depreciation for the equipment is $850. Let's make sure we understand what depreciation is in this class. A lot of us will try to assimilate it with what the real world is, decrease in value. Well, kind of. What depreciation expense is in our class is where we expense the cost of a property, plant, and equipment asset over the time we're going to use it. Now, what is a property, plant, and equipment asset? It's an asset that is tangible, so you could see it, you could touch it, and you're going to use it for more than a year. Okay? So we're talking land, buildings, equipment, furniture, vehicles. Those are the typical types of assets that we purchase with those intentions. Now, we expense the cost of these assets if the asset will deteriorate over time. So all of those assets will except for land. So land is the only property, plant, and equipment asset that you will not expense. In Chapter 10, we show you how to calculate the amount of the expense. You actually have a choice on how you would like to calculate it. For the purposes of Chapter 3, you just need to understand what it is and how to create the journal entry for it. So according to our calculations in Part D, the amount of depreciation for the equipment is $850. Depreciation is always an expense. You will debit the depreciation expense, and it's a normal expense just like any other expense, for $850. That's the amount of the cost of the equipment the company has determined it used up during this year. We do not credit the equipment account directly. What we do is store the amount of depreciation on the equipment, so the expense on the equipment, in a special account. Excuse me. It is an asset account, but it is called a contra asset. A contra account, which you'll be introduced to a couple of them throughout the semester. This is your first dealing with them. But a contra account is an account that gives information about another account. So it always has to be hooked up to another account. And it's called a contra account. If you think of the word contra, against, opposite. Okay, it increases on the opposite side of its buddy account. So since this is a contra asset, it will increase on the credit side. Anytime there is depreciation expense on the equipment and you debit depreciation expense equipment, you credit the equipment's contra asset account accumulated depreciation. And over the years, we will accumulate all of the expense on the equipment in that account. And we'll show you how that jives out on the balance sheet and how we use that account later. But please keep that in mind. It's just an organization account, and it's not, you can never have a contra account by itself. It always has to have a buddy because it's explaining or keeping track of information about another account. So that is depreciation. The next type of adjusting journal entry is an accrued expense. Now, an accrued expense is an expense that's occurred this accounting year, hasn't been paid yet, and it hasn't been recorded as an expense yet. Look at E. Aniston received a bill for December's online advertising. Aniston will not pay the bill until January. The key to an expense is, when did we receive the service? We received it in December. It's an expense in December. So since it isn't recorded yet, we need to record it now, and this is an accrued expense. Debit advertising expense for the $1,100, increase that account. Since we're not paying it till January, credit accounts payable, $1,100. Increase that to show as of December 31st, we owe that $1,100 at Aniston. So you've seen this already in Chapter 2 when we got utility bills and said we'll pay them next month. Let's take a look at F. This is another example of an accrued expense, but there's a little calculation involved. Aniston pays its employees on Monday for the previous week's wages. So as of Monday, December 29th, last week's wages were paid, because it goes on to say its employees earned $3,500 for a 5-day work week. December 31st falls on Wednesday this year. So on Monday, December 29th, they paid last week's wages. So what's our big deal? Well, you have to remember something. An expense does not become an expense when it's paid. An expense should be recorded when the company receives the service. So the question comes in here. January 29th, 30th, and 31st wages for our employees at Aniston will not be paid until Monday, which is in the accounting year 2019, next year. Well, that's not right. We can't wait until next year to record an expense for the 29th, 30th, and 31st of this year, because they fell in the 2018 accounting year. So we need to figure out how much of those wages of the $3,500 should be recorded as an expense now on December 31st. So if it's $3,500 for a 5-day work week, divide 3,500 by 5, that's $700 a day. And since Monday, Tuesday, and Wednesday of this week must be recorded as an expense by December 31st, that's 3 days, 700 times 3, $2,100. We debit salaries expense on December 31st. We're not paying this until next Monday. So as of December 31st, this is a salaries payable. The company owes that to the employees. Now, I remember learning this going, oh, come on, it's no big deal. We're going to pay it on Monday. But you have to remember something. Monday is not in this accounting year. And when are we making a financial statement? December 31st, 2018. We'll deal with next year next year. So those are examples of accrued expenses. The final type of adjusting journal entry is an accrued revenue. Kind of similar to an expense, but it's on the revenue side. So it's basically saying this. It's a revenue that's been earned by the end of the year, by the time you're going to do that financial statement. But you haven't received any cash for it yet, and you don't have it recorded as a revenue yet. So let's take a look at G. On October 1st, Aniston agreed to provide a 4-month air system check beginning October 1st for a customer for $3,400 in total. Doesn't say anything about the customer paying any money, nothing so far. Aniston has completed the system check every month, so October, November, and December. hasn't received any payment, and has made no journal entries related to this service that they performed. So the question is, did they perform any of this service? And the answer is yes, 3 of the 4 months. Then they have revenue that needs to be recorded by the end of the year. So we take the $3,400, which represents, sorry, 1 second. Okay, 3,400 for 4 months, $850 a month, times 3 months, October, November, and December, they've performed the service. So they should credit service revenue $2,550 for the portion that has been earned by the end of the year. Since they haven't received a payment or anything yet, it's owed to them. Debit accounts receivable. So that is the typical journal entry you'll have for an accrued revenue. A revenue where you've performed the service, haven't received any money yet from the customer, and haven't even recorded it yet as revenue. Okay, so as I said, these are the typical types of adjusting journal entries. I don't want you to think that you have to have one in each category, okay, or that you can only have one in each category. I've worked at companies where I never had an unearned revenue adjusting journal entry. Why? The company I worked at never received cash before performing the service for the customer. Okay, and I've had adjusting journal entries that are in the accrued expense, 15 of them. Okay, so we're just telling you they could usually fall into one of the categories. You're not always going to have all of them in a company, and you may have a lot in one category in your company. So just so you're aware of that. So that's the hard part of Chapter 3. Figuring out how to take this data, what it's telling you, and creating the journal entry to get the revenue or the expense recorded properly. And I encourage you to post any and all questions you have about this. Now, the rest of the chapter, or the continuation of our accounting cycle, is once we have these journal entries, just like our other journal entries, we got to post them to the T accounts. So mine isn't the prettiest, but let's take. So here are the T accounts that you created already. Now, they're already updated for our adjusting journal entries, but you should have those in front of you. The cash account had a debit balance, so debit's on the left, credit's on the right. Accounts receivable, debit balance. But if you go over to accounts payable, the credit balance. Okay, so you can see, I know it's not the prettiest, but you can kind of make out where the debit side is and the credit side is on each of my T accounts here. Then if we go to our adjusting journal entries we just created, each one will be posted individually to the T account affected. For instance, journal entry A. Let me see if I can get my highlighter going here. Yeah. Journal entry A, sorry. It's on the debit side of unearned revenue, $2,100. On the credit side of the service revenue, $2,100. Journal entry B. On the debit side of rent expense, debit $1,450. On the credit side of that prepaid rent T account, $1,450. Journal entry C. On the debit side of the supplies expense, $750. On the credit side of office supplies, $750. Journal entry D. Here's that new expense account, debit depreciation expense. Debit side of depreciation expense, $850. And that new contra asset on the credit side of accumulated depreciation, $850. You can see there was a credit balance in that account to begin with. So far, what that's saying is, so far, the company has expensed $3,900 of the equipment. E. The next one, I'm finding it here. On the debit side of advertising expense, $1,100. On the credit side of accounts payable, $1,100. On the debit side of salary expense, $2,100. On the credit side of salary payable, $2,100. And then finally, on the debit side of accounts receivable, $25.50. On the credit side of service revenue, $25.50. So you only have to hit those accounts that were affected by the T accounts. Now I'm going to go to a different color here. Let's try green. Okay. So after you post each one of those, find a new balance in each account, including ones that were not affected. These balances are now called the adjusted balances because they're the balance in the T account after updating them for these adjusting journal entries. Take a look. Before these adjusting journal entries, accounts receivables 19,700. No, when in fact it should be 22,250. Prepaid rent should be at 1450 debit. Office supplies, 1,800 originally. We credited it for 750 up. Now it's down to a $1,050 balance on the debit side. Equipment didn't change, and some accounts won't during this process. But look at accumulated depreciation. It went up $850. It's now at a credit balance of $4,750. Accounts payable went up $1,100. Now it's a $4,000 balance. Salaries payable didn't even have a balance. Now it's at $2,100. Unearned revenue decreased because we provided that service, so it's down to a $1,000 balance. Capital won't change during this process, nor will your withdrawals. But look at service revenue, and look at that. This really shows you. If we didn't do these adjusting journal entries on the financial statements, we would have reported there was $15,300 in service revenue, when in fact there was $19,950. Salaries expense, we would have reported $3,300 when there's really $5,400. We wouldn't have even reported rent expense if we didn't do these adjusting journal entries. Wrong, there's $1,450. Same with depreciation expense. There wasn't anything there before those journal entries. Now there's an $850 debit balance. Advertising expense increased also. Its true balance is $2,900. And look at supplies expense. Look at all those items that were missing that we now have recorded. And that's the purpose of these adjusting journal entries. So we come up with these new and improved adjusted balances, and we go and create our second trial balance using those T accounts that are updated, called the adjusted trial balance. And just like before, you're going to put the name of the account and the current balance. So we're listing the balance after adjusting journal entries. Trial balance is a trial balance. List each account with its current balance. So as you can see there, cash, $7,600 debit balance. Accounts receivable, $22,250. Prepaid rent, $1,450. Office supplies, $1,050. Equipment, debit of $22,000. And accumulated depreciation equipment, a credit of $4,750. Compare those balances to the ones in your book, and look at how we updated those. Then we go to the liabilities. Accounts payable, $4,000. Salaries payable, and these are on the credit side, $2,100 credit. Unearned revenue, $1,000 credit. So some of those liabilities changed as well. Capital remains at $43,800 credit, $9,900 debit for withdrawals. Now report the new and improved revenue and expense amounts from those T accounts we just updated. Credit service revenue, $19,950. That's a credit balance, I should say. Salaries expense, debit of $5,400. A rent expense balance of $1,450. Depreciation expense equipment, a debit balance of $850. Advertising expense, a $2,900 debit balance, and supplies expense, a $750 debit balance. Compare those balances to what you started with. So you can see how this process really updates all of our accounts so that we have recorded and will report all the revenues and expenses that have indeed occurred during our accounting cycle. It is this trial balance that we use to create the income statement, statement of owner's equity, and the balance sheet, as well as the statement of cash flow. Now, as I said, we have to make those financial statements once a year. So you have to do adjusting journal entries once a year. However, in the real world, when I worked out there, I made financial statements for my boss every month. So I did these adjusting journal entries every month, and that's the key. When you're going to do financial statements, you must make sure all the revenues and expenses are reported, and those missing revenues and expenses usually fall into one of those 5 categories of adjusting journal entries. Okay, so that is P3-35A. So please go through that problem, make sure you understand that process, and post any questions you may have to the discussion board.